Welcome to the Capital News. I am your host, Alex Karitis. Today is Wednesday, May 13th, 2020. Thank you so much for joining me. Title of today's podcast, Negative Rates Are Coming. Not a question mark. This is an exclamation point. Okay, they are coming. It is just a matter of time. Of course, they are here in real terms. And all of the analysis and the conversations we've had previously with the expansion of the Federal Reserve's balance sheet, that means we have negative interest rates already. We are just waiting for that official little minus sign before the number, which of course would only come when the Federal Reserve meets and says as much. Now, they're not likely to do this in the near future, meaning the next few months, but by the end of this year, early next year, they're pretty much going to be here. I'm almost 100% certain of it. And of course, the reason why we're talking about negative interest rates today, a little bit being obviously the main focus of today's podcast, is because the chairman of the Federal Reserve, Jerome Powell, was out and had a brief conversation, a brief little interview with someone from the Peterson Institute for International Economics. And of course, negative rates was all the rage because, of course, as we have been discussing here, the futures markets, when it comes to the federal funds rate, entered ever so slightly negative territory out early into next year. So, of course, everybody wants to ask the question, are we going to go there? Are you going to do it? What's the thinking? What's the philosophy taking place right now within the Federal Reserve? What is going to happen? How do you obviously foresee things progressing as we make our way through this pandemic? All of those types of questions. Well, market performance. Of course, let's hit market performance, and then we'll get into that interview. So market performance, the markets were down again today. Here in the U.S., pretty much across the world as well. 1.5%, 2%, depending on the index. Small caps were down about 3%, maybe a little bit more at the close. Not surprising. We said be on the lookout. Again, yesterday they were down, but we said, look, one day does not make a trend, but there was a lot of sell-off. There's a big sell-off at the end of the day, and that's typically a sign, something to pay attention to. So don't be surprised if there was follow-through, and that's exactly what we saw today. We saw that follow-through. The question is, does 2 days, is that going to start a trend? Is this just a little bit of a pullback from really one heck of a rally? Is this going to turn into another bigger correction, 10%, or is this just going to be the continuation of what we think here is the bear market? And maybe we're going to go and test the lows, retest the lows. Maybe we're going to go through them over time. Remember, bear markets, just like bull markets, are a process. These things take time to play out. But nevertheless, even on the back of the words from the chairman of the Federal Reserve, the markets still sold off. But right now in futures trading, we have the Dow, the S&P up slightly, about 0.1%. The NASDAQ 100 is up about 0.4%. Japanese markets are down about 0.8% in the cash trade. Across the pond in Europe, they were down big in the red, ranging anywhere from down 1.5% to 3% down in France. And right now during the cash trade in Australia, they are also down, trading down 0.8%. On the commodity front, we have WTI trading at $25.60 a barrel. Brent, the international metric, at $29.37 a barrel. Natural gas continues its slide down. $1.63 per million British thermal units. Gold and silver relatively unchanged. Gold trading at $1,712 an ounce. Silver, $15.48 an ounce. And we have Uncle Sam's 10-year Treasury note yielding 0.64%. So, markets didn't like it because, do they really want negative interest rates? I mean, do you really want them? I mean, there are some people out there who think, well, if we get negative interest rates, well, then that's just going to be more fuel for the stock market. Are you sure about that? Have you looked at the Japanese stock market? Have you looked at the European indexes on their own or in aggregate? It doesn't work out too well. Now, it's a different society over there, obviously, in both places, even though there's a lot of similarities with us in Europe. They tend to be more savers. They tend to be maybe more prone to getting involved with bonds, as opposed to here in the United States where we're more prone to get involved with stocks. So you sort of have that potential argument there that could hold fruit, that could bear fruit if we do get negative interest rates. That could be a further quote-unquote catalyst for some sort of melt-up, or at least to sustain higher prices within the stock market. So that's a possibility, but it's also a possibility that it's just not going to work, because they have not worked in Japan, and they have not worked in Europe, and they continue to use them because they're out of ammunition, they're out of tools, they don't know what else to do. Telling the people the truth is pretty much never an option for politicians, policymakers, central bankers. Just not going to happen. So you can just pretty much remove that from the onset. So what to do here in the United States? Now, of course, Jerome Powell is emphatic. They're just not going to take place here in the United States at this time. At this time. Okay, here's what we have here. Officials most recently discussed it, meaning negative interest rates, during last October's meeting. And the minutes said that all FOMC participants, and that's not a sentence you get to say very often, all FOMC participants currently did not judge that negative rates appear to be an attractive monetary policy tool in the United States. Now, you have to read this carefully, right? All FOMC participants currently did not judge that negative rates appear to be an attractive monetary policy tool in the United States. This was back in last October. A lot has transpired since last October, has it not? And those words, again, currently and attractive. So this is basically saying just keep drinking until she looks attractive. That's the analogy here, because this economy is going to get uglier and uglier and uglier. And these policymakers at the central bank, already out of ammunition, of course, they're going to say that they're not, but that's also one of the things in their toolkit, is jawboning, trying to get their message out in the hopes that the crackpots and crackheads on Wall Street buy into it and think that they actually do have some lead in those bullets still, when they don't. They're empty. And it's just going to be a matter of time until the markets wake up to this realization, when they wake up to the fact that we are in a bear market. And a lot of people trading out there, especially younger people, have never been through a bear market. They have no idea what one looks like. They have no idea of the volatility. So you're in for a rough ride. And then you tack on all of the other issues with the pension funds, people getting closer to retirement age, the baby boomers retiring, all that jazz, what to do with your retirement, what to do with my investments, people not working, my 401k, well, I'm not contributing to it, I'm not working, my employer isn't matching because I'm not working, so there's nothing going in it. What do I do? What do I do? What do I do? All of these things are coming to a head. Okay? And we talk about the costs and the implications of all of this. And printing money is not a panacea, but they're going to continue to do it. And of course, the Federal Reserve wants to shy away, at least right now, rhetorically, from adopting negative rates. But we know very well that the market gets what it wants. Jay Powell can come out and thump his chest, flex his arms, act like the tough guy, pretend to be the strong man, and then he caves. President throws a hissy fit. Stock market throws a hissy fit. He caves. Does an about face. We talked about that here just yesterday, that these people are not to be trusted. So that's why you got to look at these comments. That's why you got to read these transcripts very closely, word by word. Last October, all FOMC participants currently did not judge that negative rates appear to be an attractive monetary policy tool in the United States. Well, maybe now it's going to be attractive, or in several months' time it will be attractive. And we all know Thunder Thumbs is going to be talking about negative rates until he gets them, because that's what he does. So they are coming, not because the president wants them, but because it's going to happen, because it's really what the market is calling for. And the market better be careful what it wishes for, because we have the Japanese markets, which peaked out late 80s, early 90s, and the Nikkei has not gotten 50% back to that level. Look at Europe. It's crashing as well. Its financial sector, banking stocks, through the floor. And we are just waiting for one of these major banks to collapse, whether it be Deutsche Bank, Commerce Bank, any of these banks. Could be Italian banks, French banks, Spanish, you name it. They are on the razor's edge. Believe me when I tell you. And there was some news out from Commerce Bank today, of course, using COVID-19 as a convenient excuse. Oh, even, we were coming back so strongly, but now, all of these loss provisions, everything that's taking place, this is really throwing us off kilter once again. No surprise. They were never on the path to recovery. Remember, the Germans were trying to merge two piles of crap together, Deutsche Bank and Commerce, and then somebody finally realized two big pieces of crap just makes one really big piece of crap. They said, that's probably not a good idea to do. And then they went away, right? We talked about that months ago. Same thing. And the other interesting thing, too, I'm going to get back, obviously, to Jay Powell. But something else, because we talked about this the other day here, too, with the German Constitutional Court ruling that the ECB has to be careful with what they're doing and has to provide an explanation justifying their actions when it comes to further measures of quantitative easing, purchasing bonds outright, anything they want to do moving forward. There has to be a rationalization that is going to adhere to the German Constitution. Well, now there's some pushback from the Eurozone at large, perhaps threatening to sue Germany. So we've been stating here for months, and I've been of this mindset for years, but I've only been on this podcast here for a little over a year, that the Eurozone is going to break up. It is going to break up, that the euro, the currency, is not going to exist, or at least not in its current form, within a decade, maybe very much sooner. Time will play out. You look at the debt levels there, the deficits, the nationalization, people saying, well, look, we have a better government here. That's just hypothetically, at least. We have better finances here in Germany than we do in Italy. We can't be bailing them out. Not going to happen. We're not going to play this game again. We did it 10 years ago. It's not going to happen now because we have problems this time too. 10 years ago, we still looked pretty, but now we're hurting as well. So be on the lookout for this because they're going to they're going to play the blame game too. It's not just U.S. and China or the rest of the world versus China. It's going to be European countries continuing to point the finger at other European countries. Here in the United States, if things really get ugly, and we're already seeing a lot of the talks of bailing out the states, right? Well, maybe Texas is going to be upset that New York is getting bailed out or vice versa. Okay, so just pay attention to all of this because it's all connected, as we like to say, because it is. Now, another interesting point that Jay Powell mentioned was a survey that is soon to be released from the Federal Reserve noting that about 40%, 4 in 10, people who make less than $40,000 have lost their jobs. Let me repeat this. 40%, 4 in 10 people who make less than $40,000 a year lost their jobs. And I think that if I remember correctly, this was just for the month of March. So this doesn't include what took place in April as well. 40% have lost their job. Now, a little bit of context because we mentioned this the other day too, to provide a little bit of context to what's going on the Federal Reserve and the federal government, especially with all of this endless, quote-unquote, stimulus, right? And all we used was the $3 trillion figure. And this is not Nancy Pelosi and the Democrats' bill of $3 trillion. This is the $3 trillion that the United States Treasury is going to issue throughout the second quarter of 2020. So April, May, June. So we're already in the process of this. The $3 trillion that's already going out there. We have to borrow it because we don't have it. And remember, again, for perspective, $3 trillion, $3.5 trillion is what the United States federal government collects throughout the entire year in tax revenue. We're going to go through that in 3 months. In 3 months. So the example we used, just using that $3 trillion, and of course the price tag on this is going to be much larger than that, but we said let's just keep it simple. $3 trillion, nice round number, and then we'll use the 33.5 million Americans who have lost their jobs, who have filed for unemployment insurance over the past 7 weeks. You do the basic math, it came to about $89,500 per job. Now, does that make sense to you? When 40% of people making less than $40,000 a year have lost their jobs, we're going to spend $89,000 to recover, perhaps, hopefully, but it's not likely, at least not 100% of them to come back. We're going to spend $89,000 to get a job back that pays less than $40,000, and we know a significant portion of the jobs that are being lost are lower wage. Those are always the first to go, especially in this type of environment, because this is the service sector. This is the entertainment sector. This is hospitality, tourism, vacationing, restaurants, conferences, conventions, catering. That's what these people make. Minimum wage, below minimum wage, because they make a lot of their money on tips. So we're spending $89,000 to recoup a job that pays $40,000. How are we ever going to pay this back? And of course, there are people who've lost their jobs who make $89,000 or more, but that's not the significant portion of them. So does this make any financial or economic sense? And the answer, of course, is no. And that's why we are against these bailouts, because they do not make sense. They kick the can down the road. It allows politicians, central bankers, and other policymakers, it gives them the appearance that they're doing something. Because God forbid they too sit down and look at you in the face, even through a camera lens, and tell you the truth as to what's been going on here. That the American dream is really a Ponzi scheme. Unfortunately. Now, you can still make it in this country. You understand this. I'm a free market capitalist. You can still make it here. There's no ifs, ands, or buts about it. But it is becoming that much more difficult because of the policies that we adopt and the politicians that we continue to elect year after year after year. And then we scratch our heads in wonder and in awe as to what's going on. And conveniently, all of these suckers have a pandemic to blame it on this time. So $89,000 to recoup a job that pays $40,000. And this is just the tip of the iceberg. We've only been involved with this shutdown really here in the United States for 2 months. Okay? Tip of the iceberg. All the other fallout, jobs not going to come back. It's going to take a long time. Of course, some people, a lot of people, making more being unemployed than they were when they were working. So what's the incentive to get back to work, especially if we're still making our way through the first wave and people are fearful of getting involved or caught up in a second wave? Don't want to send their kids back to school, maybe taking care of an older parent. I can't get these people sick. I can't be responsible for that. I can't have that on my conscience if something happens, God forbid. But I'm making more unemployed, so I'm just going to stay there. Well, how does that affect smaller businesses, mid-sized, but any business that's trying to reopen? How are they going to lure those workers back into the workforce? Are they going to pay them more? Highly unlikely, because the demand side of the picture hasn't materialized yet and most likely is not going to for some time. So their margins are going to get squeezed at a very time when they need every precious penny they can get. This is all wrong. And this is why you cannot pick winners and losers. You can be as well-intended as you want, but these are the problems that happen. This is why I always go back to history. What took place in the Great Depression? Late 1920s, early 30s. The government is doing the same thing. It's just really on overdrive this time. Maybe they're well-intended. Maybe they're trying to do a good thing. Maybe they're trying to look like they are leaders and have a grasp and a handle on all of this. Of course, they don't, unfortunately. And now people are going to have to pay the consequences of this, because $89,000 per job when most are $40,000 or less. Do the math, people. This is stealing from the future. And it's just to fill a void. This is just to fill a void. This is no great grand infrastructure being built. This is no major advancement in our educational system. This is no pullback from being the policeman of the world and meddling in everybody else's business. This is not any type of alleviation of student loan debt, which of course I'm not for that either, or anything else of that matter. There is not anything to show except, well, we threw money into a hole that's getting bigger and deeper and wider by the very second, because we're just not going to man up and tell the American people that this system has been nothing but a facade, nothing but a charade, predicated on money printing and deficit spending and kicking the can further and further down the road. That's what we have. So negative rates, not something we're looking at. It's not attractive right now. We'll keep drinking. It'll look attractive sooner rather than later. Powell also said policymakers prefer alternatives such as forward guidance. So that's their jawboning. That's coming out and making announcements, trying to get ahead of the market or to lead the market in some direction, or hard signals of how long current policy will remain in place, and large-scale asset purchases, also known as quantitative easing or QE. Continuing, he says, quote, "We've said that we continue to rely on those tools that are tried, and they are now a part of our toolkit," end quote. He said, now, what a travesty this is, that these fraudulent and flawed policies over the past 12 years are now really part and parcel of their toolkit, and they think they work. Because Jay Powell said, there's no bubble to pop. This entire 12 years, 11 years, whatever it was, of the longest economic expansion in the history of the United States, which was also the weakest, but also the longest, there's no bubble to pop. Forget stock valuations being at levels that we haven't seen since 1929 or 1999 in the year 2000. Both, of course, when those bubbles popped, you saw stock market crashes by the time the process ended, down 80 to 90%. Are you ready for that? Does the Federal Reserve think somehow magically they can just print money and keep that from happening? Even if you lost 50%, that would be hugely detrimental because you would need to gain 100% just to get back to where you were before. And all of these quote-unquote miraculous gains that we've seen over the past 12 years have been at the result of financial price asset inflation. Because of the printing press. Because of a huge wealth transfer. So to think that once the dust settles, we're just going to get right back on the train and get right back up there, I'm highly skeptical of. Because we didn't have this much debt 12 years ago. We didn't have as many baby boomers retiring 10 years ago. We didn't have as much student debt 12 years ago. Credit card debt, auto debt, mortgage debt. It's all gone up. Corporate debt. It's even worse this time. So how do you think it's going to be better or the same as soon as this passes? It just doesn't pass the smell test for a second. You just got to stop, take a deep breath, and think for a minute. So there's no bubble to pop. Not in the housing market, not in the commercial real estate market. Student debt, evidently not a problem. There's nothing's going to pop there. Credit cards, autos, evidently that sector is just humming along. Nothing to see there. We talked about the renters market yesterday. These are no problems, according to Jay Powell. None whatsoever. Corporate debt being higher than it's ever been. Again, the stock market valuations on multiple fronts, the highest we've ever seen or close to it. No bubble to pop. This is not the usual suspects he mentioned. This is all COVID-19. All of it. All of it. Despite the fact that we had a near $1 trillion deficit last year, and it really was. I mean, the one that the government tells us, it was $984 billion. But of course, when you take the year-over-year change in the national debt, it was north of $1 trillion. We discussed that here on this podcast in further length in our capital economics presentation. Debts and deficits, do they matter? Check those out on thecapitalnews.com or our YouTube channel at The Capital News. Right? This was all before COVID-19. Check out our letter. Representation and recourse on thecapitalnews.com. Check out that letter. I give a list, one after the next, and I could have kept going about how many things were wrong prior to COVID-19. And what else did I address in that letter? Exactly what has been taking place and exactly what Jerome Powell said here today. And I wrote that back in March. And I was talking about that before that letter came out. That they are going to use COVID-19 as an excuse to justify the unjustifiable. That's exactly what they're doing. Circumventing the Federal Reserve Act. And that's another interesting thing that Jerome Powell mentioned today in his interview. He's saying all of this stuff that's taking place above and beyond what we're allowed to do from the Federal Reserve Act. So all of this other crap that they're getting in with corporate bonds and all these other markets, that's all at the approval of the U.S. Treasury. The Secretary of the Treasury, he has to sign off on everything. And of course, that means Steven Mnuchin, obviously, but it also means Donald Trump. It also means Donald Trump. Because he is in control of everything, or pretends to be, or wants to be. No oversight, remember. No inspector general to know where this money is going. And a man who is obsessed with the stock market. So how do you think this is going to play out? Or at least, what do you think he's going to try to do? He's going to try to juice this thing till the cows come home. And then some. This is also the way for Jay Powell to punt, right? To give this, look, we're doing what we can do. We're bound by the Federal Reserve Act. Now, of course, we have this magical stimulus bill that gives us some other, special purpose vehicle, SPV, through the Treasury Department to go about and do some other things. But the Treasury Secretary has to sign off on it. So, yeah, we might do things, but we can't do them unless the federal government also gives us their blessing. So this, too, is going to be some of the blame game. Because he says, look, there needs to be additional fiscal policies. Now, he doesn't go into detail as to what they're supposed to be because he doesn't want to go too far in stepping on the toes of the White House and Congress as to what laws they're going to come up with. But we think additional fiscal policies will be needed because, monetary policy can only do so much. $2.5 trillion here, $2.5 trillion there. Oh, we can only do so much. And then he makes a good point, and something that we've discussed here before. Liquidity versus solvency. So the Federal Reserve, we can do a great job at handling a liquidity crisis or a liquidity problem because we can just turn on the printing press, get those computer screens on, 0000, just we can add it to a digital screen, put it out there, presto, not a problem. But liquidity does not solve a solvency crisis, and that's what we are in the midst of or going to be in the midst of because that means bankruptcies, that means liquidations, going out of business, right? And of course, understand, we've discussed this before, just because a company's going bankrupt does not mean they are going out of business. That would be liquidation. They're gone. Bankruptcy is a restructuring, and that is what is supposed to be taking place in this country. That is how a free market would resolve itself. Bankruptcy, restructure. Your debt holders, they'll take a haircut. Instead of getting $100, 100 cents on the dollar, they're going to take a haircut, get 75 cents, 60 cents, 50 cents, whatever they agree upon. Maybe those bond holders will come in and become the new management or get the biggest say as to who comes in as the new board members, as the new CEO and the other executives, and they work out some agreement. That debt is swapped for equity, whatever the case may be. That's how that's supposed to work. It's not supposed to be at the hand of the Federal Reserve, the federal government, picking winners and losers. So he makes a very important and valid point. Liquidity does not solve solvency issues. And he's right, because it doesn't. If you don't have demand, if you don't have customers coming in the door, you have a problem. Doesn't matter how much money the Federal Reserve prints. If you're not allowed to go outside, or you don't feel safe going outside, or you've realized, my goodness, we're going through this event, I didn't have any money saved up whatsoever. I have to be a lot more conscientious as to how I'm going to spend money going forward. Well, you add that up over a country of 330 million people, and you have a problem when it comes to the demand side of things. Federal Reserve is impotent. They can't do a damn thing about it. They can churn those printing presses as much as they want. They can give as much forward guidance as they want. It's not going to mean a thing if you don't go out and spend that money. That's a problem. And that's the other problem when it comes to picking winners and losers, because what this does, throwing all this liquidity out there, is it allows companies that would otherwise have gone out of business to remain in business. So now we have a plethora of zombie companies walking around, which are not only destructive to themselves, but they are destructive to consumers, and they are destructive to other producers, other suppliers, whatever industry that might be. We've given the example of restaurants. There are so many restaurants, unfortunately, that should be out of business, but they're being kept up. They are being propped up as zombie companies. And that is going to take market share away from those restaurants that could have weathered this storm. And now when you start picking away at people, little by little, a couple percentage points here or there in that market share, that's going to be devastating in the long term. Death by 1,000 cuts, especially when these economies start to quote-unquote reopen. What are going to be the rules? What are going to be the regulations? Yeah, you can open up your restaurant, but you got to get rid of 25% of your tables. If you lose 25% of your business every week, every month, for a few months, can you survive? Death by 1,000 cuts. Check out the podcast. That's where we come up with these titles, because that's what it is. So liquidity versus insolvency, something to pay attention to. What else do I have here? That's pretty much summing everything up. It's going to be very interesting what takes place at the fiscal level in Congress. Will they push forward this $3 trillion monstrosity on top of trillions more that they've already passed? How many phases are we going to go through? It's a political year. It's a presidential election. The balance of power is at stake here. These politicians want to get reelected. They like their cozy positions. They like their six-figure salaries. They like their pensions. They like their benefits. They don't want to lose them. So, of course, they're going to say, oh, well, look, we're coming to the aid of the everyday American. And then it's going to be the finger pointing. Oh, we can't afford this. Future generations are going to have to pay for this. That we can't do that. Well, you're going to do that to the everyday American? They're suffering. They need $1,000 or $2,000 a month. You can't even give them that for a few months? How dare you, you evil, wicked people. So it's the blame game. It's everybody jockeying for position, getting their face on camera. It's all it is. It's a big game. But guess who's going to have to pay for all of this at the end of the day? You and me, the taxpayer. We're already paying for it. We see the fraud and the failure of these policies. People living paycheck to paycheck, not having $400 in savings in the event of an emergency. That's gone. That's long been gone now. Was that stable? Was that sustainable? Is that what we want to go back to? Is that what we're in such a hurry for, this V-shaped recovery, this mystical, magical, miraculous V-shaped recovery that we're supposed to see? We're supposed to be in a hurry to get back to that? Something that was unsustainable? Living beyond our means? And if we've lived beyond our means for decades, wouldn't that mean, at least in some part, a significant portion of time, we're going to have to live well within our means moving forward? Piper needs paid. He's coming to collect. It's that simple. It's that simple. So negative rates are coming. It's just a matter of time. It's just a matter of time. And look out, because eventually they'll come for your deposits. Now, that won't be immediate. That will not be immediate, most likely anyway. It was a slow process over in Europe, and I think they've just started doing it recently, that they are now, charging depositors their money. Instead of getting interest for having an account, they're taking it from your account. Now, that's for some of the larger account holders, but they're going to slowly make their way down to the average Joe and Jane in the European Union as well. Negative rates are coming. We told you so. Please like, share, subscribe, get the word out, leave your comments. We do love hearing from you. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.